Is the Opendoor party over? Why am I saying this? Because, well, the stock is down close to 20% after the company reported its quarterly figures. Now, the thing is, the quarter was as expected. It was an okay quarter. I mean, okay, all things considered. Guidance, for those that think, oh, guidance was super weak, why is revenue coming down? This again, if you listen to what management has told us 3 months ago, you would have known that revenue for Q3 and Q4 would have been down by design and also because of the macro situation that we're in right now. Now, there are also some things that they cannot control, and which is why contribution profit, the margins there, are not going to meet their own goals for this year. Okay, maybe that's something we should have taken into consideration, but fine. But the stock is down right now. Adjusted EBITDA was positive for the first time in 3 years. That doesn't mean that this was a profitable quarter. I've seen people say, oh, this is the first profitable quarter in 3 years. No, this is a company that is still losing money. Adjusted EBITDA does not equal being profitable, just so we're clear. Then as for guidance, adjusted EBITDA, a loss, again, of around $24 million at the midpoint. Now, I've seen already some people that have been very, very vocal on the name that said, oh, the positive thing is that next quarter adjusted EBITDA is basically flat. It's not basically flat. Just like this quarter, the $23 million in adjusted EBITDA wasn't considered flat, right? So next quarter, when it's a $24 million loss, we shouldn't consider this as flat either. It's a $24 million adjusted EBITDA loss. Now, all of that said, the stock is still up 29% year to date. The stock is still up 227% over the last 12 months. Just so we are all on the same page here. Now, moving forward, since of course we talk about Opendoor, we compare it a little bit to Carvana, but I explained the whole story about Carvana and why Carvana stock 100x. It's because the business became just much better. Opendoor will not become a 100x or even a 10x just because of wishful thinking, right? You're not going to get Zillow types of multiples when you don't have Zillow type margins. That's just how the game works here. In order to get higher EV to sale multiples, you need to get a profitability profile, a margin profile that warrants a higher multiple. You also need a better macro environment, especially for a business like Opendoor. Can all of that happen? Yes, but it will not happen tomorrow. It will not happen next week. It will definitely not happen next quarter. It will take time. But in order for you to get your 10x or maybe more, you need patience, right? Everybody wants a 10x, a 100x, but nobody wants to wait for it. That's the problem. Now, let's go over everything you need to know for the quarter with regards to Opendoor. If you enjoy this type of videos, hit all the buttons. I am going live pretty soon to cover Uber, Shopify, Novo Nordisk, Oscar. So make sure you have that notification bell on so you don't miss any of the future live streams. All right, so first up, they generated $1.6 billion of revenue, representing a 5% increase year over year. They also sold 4,299 homes. They delivered $128 million of gross profit and $69 million of contribution profit. They narrowed their net loss to a loss of $29 million, which again means this is not a profitable quarter since they are losing money. Now, adjusted EBITDA was positive, $23 million for the quarter, and this is the first quarter of adjusted EBITDA profitability in 3 years. Now, looking ahead, they believe housing market weakness will persist, and they are not assuming any near-term catalyst for improvement. So, of course, any real near-term catalyst that might happen, whether it's rate cuts or, well, it's rate cuts, let's be honest, is not included in their guidance at the moment. They expect to see sequential acquisition and resale volume declines driven by a combination of macro dynamics, typical seasonal pattern in their cash offer business, and the early stage nature of their platform pivot, which will take time to mature. I'll talk a little bit about that. We are transitioning our business model during a historically difficult macro environment. The benefits of this evolution will take time to materialize. Still, our Q2 results underscore the progress we've made, $1.6 billion in revenue, first quarter of adjusted EBITDA profitability in 3 years, a clear reflection of the cost discipline and operating leverage we've developed. While we don't expect to maintain profitability in the back half given lower acquisition volume and inventory levels, this milestone is a meaningful indicator of the substantial progress we are making. Looking ahead, amid heightened uncertainty from shifting economic policies, the evolving tariff landscape, and geopolitical tensions, the broader macroeconomic environment remains challenging. The US housing market is no exception. With mortgage rates hovering in the high 6% range and affordability near all-time lows, buyer demand remains persistently weak. Only 12% of consumers express that it is a good time to buy a home, and sellers currently outnumber buyers by the widest margin in over a decade. This has led to low clearance rates, decade-high delistings, and gave rise to the slowest spring selling season in 13 years. We expect these trends to continue to weigh on the housing market through the second half of the year, although they did say that at the start of Q2 things were worse than at the end of Q2, but the situation at the end of Q2, they do expect this to continue in Q3 and Q4. Of course, if there are any changes, then they'll update us accordingly. As for guidance, they expect home acquisitions of approximately 1,200, so of course way less than in Q2. Revenue, $800 to $875 million, again, as expected. Contribution profit between $22 and $29 million, which implies a contribution margin of 2.8 to 3.3%, and adjusted EBITDA loss, according to midpoint of $24 million. While we're not providing full year guidance, we'd like to provide some additional color for the balance of the year. Given our expectations for our continued challenging macro, typical seasonal patterns in our cash offer business, and the early stage nature of our platform pivot, we expect Q4 revenue to decline sequentially at a similar level to the 3Q sequential decline. So again, shouldn't be getting better in Q4. Contribution margin will also be pressured in the second half by an unfavorable mix of older, lower margin homes, given lower acquisition volumes, likely putting our goal of the year-over-year contribution margin improvement out of reach. Now, to see exactly what has happened, you can clearly see the trend here. Home purchased for the quarter have come down quite drastically. If we then look at the home sold, they did quite a good job for the quarter, which is why we have seen a nice increase in revenue to $1.6 billion, which also means that homes in inventory have come down quarter over quarter. I do expect them to control their inventory much better going forward. All in all, if we look at the actually percent of homes on the market over 120 days, that's still too high at 36%. This is something that still needs to be addressed. And then the last one here, real estate inventory, that sits at 1.53 billion for the quarter. Also a big decrease here quarter over quarter. So if we go and look at the changes that they've made, and these are changes that will take time to materialize. So Opendoor is moving away from being a single product cash offer company to a platform that empowers agents to offer a range of solutions. First up, the collaboration over disruption. This approach changes the flow of business by putting Opendoor's tools directly into the hands of agents who already bring a significant portion of their business. Second, they're empowering agents and sellers, so agents can now offer sellers a range of options, including cash offers, traditional market listings, and hybrid solutions. This provides sellers with more choice, speed, and certainty. The company benefits by serving more sellers, monetizing more leads, and expanding into high-margin, capital-light revenue streams. They have already seen some improvements. So pilot programs have shown compelling results, with 2 times more customers reaching a final underwritten cash offer and listing conversion rates that are 5 times higher. The process for delivering offers has been streamlined with a faster delivery time thanks to new in-home agent assessments. They also launched new products, Key Agent on iPhone, and Cash Plus, a hybrid product that are seen as significant positive. Cash Plus is considered a better risk-adjusted product that uses less capital and protects the company's downside while also aligning incentives with customers. Now, lastly here, all of this will take time to materialize. Don't expect anything to be seen here in 2025. In 2026, you can start to see things materialize. Not that drastically, especially not when it looks at contribution margin at first. Over time, probably a little bit, but for the P&L, it will take time until we actually see some positive results from these changes. But all in all, it's about making sure that the business is ready once macro turns positive. I think that once we get some rate cuts, whether it's 2 this year, 1 next year, maybe 2 next year, 1 this year, remains to be seen. I do think that it won't change the whole business, but I do think that lower rates can definitely revive the dead housing market in the United States, which in turn should help a company like Opendoor. And if there are better positions when that cycle starts, more profitable, a more better profitability profile, let's say, that would be better, of course, for the next up cycle. Again, there's a lot of ifs and buts, so don't expect things to change drastically over the next 2 quarters or so. And lastly here, looking at the stock, as you can see right now, we are back to, well, let's call it the 20-day moving average. Now, of course, when the market will open, we can have more volume. These things can go down lower. It can also rebound a little bit. The 200-day and the 50-day moving average sits at $1.50 or so. If we do open at $2, that means we're back to prices not seen since a couple of days ago. And remember, we're still up significantly from where we were a month and a half ago. But now we do have more information. We're not going to have a reverse split. We're not going to get delisted from the NASDAQ. So those are positive things. The negatives are that, well, macro-wise, we're not in a good place just yet. And the company itself is, of course, far from the full turnaround. Is it turning in the right direction? I do believe so. Can we get a little bit more excitement during the earnings call? I do believe so. But I've seen some posts, again, from Eric as well on X, talking about, oh, why wasn't this a video call? Well, 99% of the companies don't do video calls. They just do audio. Why didn't they talk more about AI, maybe Palantir or Grok? I didn't know this was a pumping scheme, but fine with that. Some of the things here are purely a pump scheme. If you really want to invest in a turnaround story, but then again, from the start, you should know that this was a long-term bet. It's a bet. It can work out. It can definitely not work out. So allocate accordingly. It's a long-term bet. If it works out, great. If it doesn't, then you lost your bet, just like when you put money on red and it's on black, or when you put on black and it's on red, or it's on zero. That can also happen from time to time. So all in all, that's about it. That's all you need to know for the quarter. See you all in the live stream. Bye-bye.